Okay, so back in March of 2021, something pretty wild happened. A single, super secretive investment firm managed to bring some of the biggest, most powerful banks in the world to their knees. It caused this massive, multi-billion-dollar shockwave. And the crazy part? This wasn't some famous hedge fund you've heard of. Their bets were almost completely hidden. So, let's dive into the incredible story of the Archegos collapse and figure out how a gigantic, leveraged bet blew up in the most spectacular way possible.
Right, we're actually going to start this story at the end, with the explosion itself. Because, in just a matter of days, this crisis erupted out of nowhere. It sent bankers scrambling and just completely torched billions of dollars from their balance sheets. It all happened so fast that it left Wall Street asking one simple question: what in the world just happened?
Get this. We're talking about more than $10 billion. That's the amount of money that some of the most sophisticated banks on the entire planet lost. We're talking about huge names like Credit Suisse and Nomura. And what's absolutely wild is that all of these losses, every single penny, came from the collapse of just one highly mysterious client.
And that really is the million-dollar question, isn't it? It's the central mystery we're unpacking here. How could one person, operating a private little family fund, build up so much risk, completely under the radar, that it could cause this much damage to the entire global financial system? Well, the answer is, frankly, a masterclass in leverage, loopholes, and just a stunning failure of risk management.
So as the fund defaulted, you can just imagine the panic inside the banks. They basically initiated a massive fire sale of stocks, dumping around $20 billion worth of shares onto the market just to cover their clients' huge obligations. And of course, the sudden liquidation completely cratered the stock prices of some major companies and just caused chaos everywhere. To really get how we got to this point, we need to rewind.
The whole story of this collapse, it really revolves around one guy, Sung-Kook Bill Huang. And to understand Archegos, you first have to understand his history on Wall Street, which is a story of incredible success, a major scandal, and then an even more incredible, almost unbelievable comeback.
So Huang started out as what they call a tiger cub, basically a protege of a legendary hedge fund manager. But then, in 2012, his career just hit a brick wall. He pleaded guilty to insider trading, paid a hefty settlement, and was effectively banned from managing money for other people. So what did he do? He did something really clever. In 2013, he took his remaining $200 million and created Archegos Capital, a family office. And that one move, well, it would change everything.
And what a comeback it was. I mean, through a series of unbelievably aggressive and, for a while, very successful bets, Huang turned that initial $200 million into a personal fortune that was estimated to be as high as $20 billion. This meteoric rise made him one of the most sought-after clients on Wall Street. Banks were literally lining up, tripping over themselves to lend him just vast sums of money.
So, the big question is, how did he do it? And maybe more importantly, how did he do it all in secret? The answer lies in two key tools that Archegos used masterfully: a specific corporate structure and a pretty complex financial instrument. This, right here, is where the story gets really interesting. Okay, first, by setting up Archegos as a family office, Huang slipped right into a huge regulatory blind spot. See, unlike hedge funds that manage money for outsiders, family offices face way less scrutiny. They have almost no public disclosure requirements, and this meant Archegos could operate completely in the shadows, totally hidden from regulators and from the rest of the market.
Second, their weapon of choice was something called the total return swap. Now, the concept is actually simpler than it sounds. Instead of buying a stock directly, Archegos would just make a contract with a bank to get all the profits, or, importantly, all the losses from that stock. It's basically like renting the performance of a stock without ever having to actually own it.
And this is exactly why these swaps were so powerful for Archegos. For one, they gave him total anonymity, because the bank technically owned the stock on their books, not Archegos. Two, they allowed for an absolutely insane amount of leverage. He could control billions in stock with just a tiny fraction of the capital. And crucially, it let Archegos completely bypass the rule that says you have to disclose when you own more than 5% of a company's stock. He had all the exposure, but technically, he didn't own the shares.
And the results of this strategy were, well, they were staggering. Just before the collapse, Archegos revealed to its, I'm sure, very stunned bankers that its gross market exposure, that's the total value of all its positions, was a mind-boggling $120 billion. And this was all built on a capital base of maybe 10, maybe 15 billion. I mean, that is leverage on a scale that few people could have even imagined.
So, let's go back to that fateful week in March 2021. With all this context, we can now see how this massive, hidden, and highly concentrated portfolio was basically a ticking time bomb. All it was going to take was just a single spark to set the whole thing off.
You know, this chart from Credit Suisse's own investigation, it tells the whole story. The blue line, that's the value of Archegos' portfolio. The yellow line is the margin, that's the collateral it owed the bank. You can see, for days, everything's fine, moving along together. Then, boom, the portfolio value just dives off a cliff, and the margin owed explodes upwards. That huge gap that opens up, that's the exact moment the fund broke.
The chain reaction that followed happened with just breathtaking speed. First, one of Archegos' biggest bets, Viacom CBS, its stock price falls hard. That triggers massive margin calls from all the banks, all at once. Archegos simply ran out of cash to pay them, and it was forced to default. And that led to the final step, this mad dash by all the banks to sell everything, which of course pushed prices down even further. It was a complete death spiral.
And the aftermath was just brutal. Credit Suisse took the biggest hit by far with a $5.5 billion loss. Nomura was not far behind. What's interesting is that banks like Goldman Sachs and Morgan Stanley, who reportedly sold their positions faster, they managed to escape with much smaller losses. It was literally a race to the exit, and the ones who hesitated paid a very, very heavy price. A painful lesson for sure.
You know, the collapse of Archegos was more than just the story of one firm's failure. It exposed these really deep cracks in the financial system, in how banks manage risk, and more importantly, in how regulators monitor it. So let's take a look at the fallout.
And look, you don't have to take my word for it. This quote is from Credit Suisse's own internal report after the fact. They called it a fundamental failure, and they noted a lackadaisical attitude towards risk. But the most damning part? They admitted the risks were conspicuous. They were obvious. They were right there in plain sight. It just goes to show you the immense pressure banks are under to make money from these huge clients, sometimes enough to make them overlook even the most blatant red flags.
Predictably, regulators have sprung into action. The whole mess revealed these huge blind spots, especially around derivatives and family offices. The SEC has since proposed new rules that would force firms to publicly disclose their big swap positions, closing the exact loophole that Archegos exploited. And across the entire industry, banks are being forced to rethink how they measure the risk coming from a single client.
Which, of course, leaves us with the big, lingering question. There are literally trillions of dollars being managed by these secretive family offices, and many of them are using very similar strategies: high leverage, complex derivatives. So while some loopholes might be closing, that core issue of massive hidden risk, it's still out there. Have the lessons really been learned, or is the system just waiting for the next big blow-up?
This is not financial advice.